Good morning and welcome to ClearPath Retirement Radio. I'm your host, Stewart Smith, and I'm here with Mitch Davies. How are you this morning, Mitch?
Doing well, man. How are you?
Doing well. Just happy to be here, and we're going to talk about some fun stuff today. I want to talk about the first part of the show today. I want to talk about just generally how investing in retirement is different than investing when you're in the accumulation phase and you're just trying to build assets and you really are approaching things with just a pure growth mindset. You know, when you get to retirement and you are switching gears into that distribution phase, your should change pretty dramatically.
Absolutely.
And I think we've learned a lot of important fundamentals about that over the years. And today we're going to share some of that and just talk about how you might want to be thinking about things as you approach that phase of life, and how your investment philosophy should probably be slightly different than what it was. And the first problem that we see a lot of times when folks come in and they've been investing for accumulation and with that pure growth mindset is that they have everything in one portfolio bucket, so to speak.
Yep.
And they're diversified and they have really good allocations, and it's fine for accumulation.
Right.
And when you're accumulating, you're just really looking for that growth. You're looking for double-digit returns, and that's fine. But when you get to retirement, what we do at our firm, and I think it's a great way to be thinking about it, is we really split your portfolio up into three different portfolios.
Yeah.
What we found that really works for folks is when you take those assets and you start addressing different needs with those assets. And when I say needs, I mean time frames, especially income needs through certain time frames of retirement. So typically what we're going to do is we're going to start addressing that by taking a portion of the assets that we think you're going to need in maybe the first 1 to 5 years of retirement. And we're going to set up that first bucket, right?
Yep. And that first bucket, we want to literally assign that money that time frame. So for that first bucket, we're going to lean on that for those 5 years. We want it to be safe, right? We don't want it to be super aggressive or fluctuate much with the market. So what that means for our clients is they know that, okay, for the next 5 years, we've got enough money safely allocated to where even if they see the headline that the market's down that day, they don't have to worry about it for that portion of their assets, which is huge in retirement, right?
Absolutely. And what we're doing by doing that is we're addressing something that most people have never heard of, and it's called sequence of returns risk, right? Sequence of returns risk basically comes down to you never know if you're going to retire in a really good market or a really bad market. And so without that crystal ball, what you want to do is you want to make sure that probably for the first 4 to 5 years of retirement, like we said, that you are not pulling the income that you need to sustain your income needs from an account that is going to fluctuate dramatically with the market.
That's right. And it's so important to do that because you can't, when you're preparing for retirement, you're working your whole career and you say, I want to retire at this date. I want to retire in 2030, whatever the year is. You've got that so set, right? And you don't know what the market's going to look like then. So to protect against those early losses, which again is so critical, because if you step into retirement and you're shifting from having that income and you're growing the account to just living off of it, and you lose 20-30% in those first years, it really sets you back.
Oof.
So that's super important to protect against.
Man, that is, and then that causes you, like Mitch said, if you were drawing income off of an account that is invested aggressively in the market, and you are taking a significant correction simultaneously in that portfolio as you're pulling the income, that leads to a lot of anxiety, that leads to a lot of fear, and what happens is you start making poor decisions.
Right.
So what we always recommend is, be taking that income in the first 5 years from a portfolio that is very conservatively, super conservatively allocated, maybe treasuries, maybe some bonds, some corporate debt type instruments, some things that are going to really be rock solid for you so that you don't make poor decisions and feel the need to sell or to get out at the wrong time, so to speak, when you are in that situation. So that is a perfect way to address that first 5 years. If you think about it historically, we've seen scenarios where folks retired in 1999.
Yeah.
And then we've compared that to folks that retired in 2003.
Right.
And I mean, the dramatic difference in what those retirements look like just based on timing alone. 1999 was what we refer to nowadays as the dot-com bubble, right?
Yep.
And it was 1999, 2000, 01, 02 were tough years in the market. And what happens when you take significant losses in the first 3 or 4 years like that is now you have a lot less money to earn interest on or to grow. And so that impacts the backside of retirement dramatically.
Yep.
And what happens is you run out of money.
Right.
Okay.
Right.
You contrast that to the same exact scenario with someone retiring in 03, where we were in a recovery, and for the next 3 or 4 years there was good, solid markets. Those folks benefited dramatically from being able to grow those assets, not erode principal in those first 3 or 4 years, and be able to pull the income they needed and still grow the principal that they originally invested, and were able to make that money last really indefinitely through retirement. So we just don't know what's going to happen. So you really just need to address that right up front. And like I say, that first 5 years, I would invest that portion of your portfolio into a very conservative allocation, something that, isn't going to knock your socks off when it comes to returns,
Right.
but is going to be very safe as far as your principal goes, give you some sort of return, and allow you to basically take the rest of your assets. And what we kind of do next is we look at years 5 through 10.
Right.
And 5 through 10, when we're in a situation where we know we're not going to need to access that money for at least 5 years, we are able at that point to take that portion and allocate it to a portfolio that is a little more aggressive, right?
Yeah, we won't go, nothing crazy, right? We're still going to have a decent bit of bond exposure, some fixed income in there. But the important distinction here is that we're, again, assigning assets to a time horizon. The mistake we see, like how this practically plays out, is people step into retirement, they've just got their whole portfolio in, say it's a 50-50 portfolio, right? 50% equities, 50% bonds. When the market comes down, they'll just start selling the portfolio overall. Now what they're doing is they don't have any money assigned to the short term, they're just selling from the portfolio and they're taking away some of their longer term exposure. Just to get to what Stewart's saying, it's very important here to have that distinction between the time horizons.
Yeah, and when you do that, when you sell out of fear like that, you're also potentially costing yourself some really nice returns on a recovery, right? Like you're not able to catch the upside when things do recover, and as with a lot of that money, because now you've gone super conservative on that, and it's not able to recover in the type of environment that it should be able to recover in.
Exactly.
So these are pretty basic concepts here, but we want to just kind of give you food for thought today. We want you to be thinking this way as you're approaching the next distribution phase that we're constantly talking about, and to really think through how you want to do this. In the next segment, we're going to address the third bucket and how we would allocate that and how that would work for you. If you think that this makes sense for you and you feel like that you want us to sit down and take a look at how you're allocated, take a look at your risk profile, make sure that you are allocated according to your risk tolerance, please go visit clearpathretirement.com and hit that Get Started Today button and just let us know. And we will look forward to sitting down with you and having our team take a look at the big picture. And when we come back, like I say, in the next segment, we're going to address that third bucket and tell you exactly how we would set that one up for you.